I saw an interesting note coming out of your firm, the House View. Is it really that bad for the yen? Are we talking Argentina and Turkey right now?
No, I mean, the comparison was a little bit more to argue that, look, Japan, the reality about Japan is how low the real yields are. It is the lowest real yields it has been on record. It's one of the lowest real yields in the world. It's definitely the lowest nominal yields in the world. And to that extent, I think what Bank of Japan is doing, to our mind, just keeps putting it further and further behind the curve. And now, while you could argue that in the case of Japan, unlike a lot of other markets, because BOJ owns so much of the JGB market, the reaction doesn't necessarily have to happen to the bond market, or the reaction can be controlled through the bond market. But the point there is that when policy becomes quite so asynchronous with what at least we see is the fundamentals evolving in the economy, and particularly how the inflation targets have been moving, or the inflation has been moving, that there is really, therefore, an increasing chance that you see a much more non-linear correction, if you might, which is to happen. That whenever the adjustment to policy happens, it happens in a bigger sort of way. So our view, for example, now is that the negative interest rates will just have to go. At this stage, we think it will be in January next year.
That would set up a very interesting set of circumstances, because wouldn't that also impact, because there's a lot of, and I should add, international interest in doing this, but a lot of domestic demand, because you can harvest the yield by, borrowing at the NERP, and then even if you're only clipping, say, your 80, 90 basis points, that's more than enough, especially considering that the carry trade is not on as much anymore. If they were to get rid of the NERP, I would imagine that it would not only have negative consequences in terms of money staying in the country, but it would also have negative consequences from the capex perspective, because that was one of the core tenets of having such easy monetary policy. If you take away that ability...
No, absolutely. This is a shift in regime, but it's a shift in regime which is responding to the fundamentals, which is that there is overall been a shift in inflation expectations. There is a much higher likelihood that we will get to that inflation target over the next few quarters, which is what BOJ has been arguing for. And I think we are now at a point where their ability, their credibility to be able to maintain that anchor of inflation target will be challenged if they don't necessarily adjust the policy in the right kind of time. I mean, the flexibility they've been trying to get with the yield curve control. I mean, honestly, if you remove the cap on the yields, the market is prone to keep testing where you find the limits to it is. So.
And I'd argue, does it even make a difference? Because for now, it's just it's a concept, because we don't necessarily know with clarity where their line in the sand is.
Absolutely. With the reference rate having moved up, where there now being flexibility around when they come in with bond purchase operations, that doesn't give any anchor, if you might, for the market to be able to then readjust. And I think in some ways, also, if Bank of Japan has to then spend money to intervene against the yen, in some ways that's money which is not necessarily going to be terribly useful, because the fundamentals kind of still point towards the yen continuing to weaken till we see a shift in the negative interest rate policy.